At any age, becoming a millionaire may appear to be an unattainable objective. That, however, is not the case. The earlier you begin to make wise financial decisions, the more likely you are to join the Millionaires Club later in life. To achieve that determination is not only the key, but also certain strategies are very essential. Hello folks, and welcome back to our channel. In today's video, we're going to give you some of the best ways for you to become a millionaire by the time you're in your 30s. Start self-sufficient living. You may believe that millionaires are those who drive flashy cars and have the most up-to-date gadgets. That isn't true in most cases, and it certainly isn't true in your case if you want to become a millionaire. This is the time to look for clearance racks or sales in order to keep your income growing. Never accept the retail price, it's just not worth it. This must be applied in the case where you go to the grocery stores, shopping malls, the internet, and even club or gym memberships. Get rid of unproductive debts. There's no such thing as a good debt issue. Even good debt, as some refer to it, is money that you don't have easy access to and that you don't have a 100% guarantee will turn into a profit later on. Such is in the case of a house. There are, however, examples of both productive and unproductive debt. For instance, a credit card can be a source of productive debt. Yes, every time you swipe a credit card, you're accumulating debt because it's not paid off until your statement is paid. Many credit cards, on the other hand, reward you with dollars or cash back if you spend within your means or solely on certain types of purchases. You should apply for this type of credit card to attain wealth in the long run. It's money that was handed to you without charge. For example, if you spend $200 in groceries, you'll get $6 back. These reward and cashback dollars add up, and they can add up to significant savings. Increase your earnings. Having the capital to fund your investments that'll compound your money is the first step to becoming a millionaire. You'll need a stable job to get this money legally. You should always strive to make yourself marketable in order to not only keep your current job, but also advance up the corporate ladder to a better position or company. Keep up with the latest innovations and news if you work in the technology business. Even if you're not in the tech industry, picking up a few technical skills can boost your earnings. Even if you're currently affluent, you should always try to improve your financial situation. Stick to the 50-20-30 budget. If you don't set aside every cent of your pay once you get it, you'll end up spending it like a maniac. It may seem daunting to have to spend every cent of your monthly paycheck. However, in this case, spending does not imply going shopping. Allocating would be a better term to use. The 50-20-30 budget, devised by Elizabeth Warren, allocates 50% of your income to necessities such as groceries, rent, and essential utilities, 20% to savings like savings account, portfolio additions, Roth IRA contributions, and so on, and the remaining 30% to lifestyle choices. This would include restaurants, your phone, your clothes, and so on. Let's look at this scenario in more detail using a real-life example. Consider the case of a $51,000 per year employee. After deducting taxes, which we'll assume are 25%, the remaining amount is $38,250. Now, 50% of the budget is allocated to necessities, which amounts to $1,593.75 per month. Utilities would cost around $80, groceries $250, gas $80, and rent $1,000 under the scenario. The savings account then takes up 20% of your income, or $637.50 per month. A $300 savings account, $200 in loan repayments, and $100 in an IRA portfolio fund would be required. Then there's your final discretionary spending of 30% of your income, or $956.25 per month. Before we get into this point in great depth, let's look at another aspect that could earn you millions of dollars by the time you're 30. Take advantage of the free money. Individuals ignore a staggering amount of free money. Employer-sponsored programs are one of the most commonly overlooked sources of free money. Some may come in the form of assistance with student loan payments. A 401k contribution match is an option many employers consider. For example, if you make a monthly contribution of X dollars, your employer will match it either 100% or at least 50%. While usually limited to a certain amount, say $6,000, that's $6,000 you didn't have before and wouldn't have had if you hadn't asked. Make sure you're up to date on these options, not only before you get hired, but also on a regular basis. Make a plan to invest. You may believe that your savings piggy bank is a wise saving, but it isn't the case as you may assume. All you're doing is letting your money sit around doing nothing. it hasn't piqued anyone's interest. This is true even of many traditional savings accounts. It isn't enough to simply have a savings account, but it's a good start. It's important to remember to save to invest rather than save to save when you're saving. Look into how you can begin putting together an investment portfolio for yourself. E-Trade is a good place to start because it's simple to use. Acorns is another emerging option that makes diversified investing more accessible to the average person. Maintain accountability. As previously stated, using services like Mint to manage your finances is a good idea. Having a slew of different accounts and cards, on the other hand, can be confusing and even prevent you from becoming a millionaire sooner. While it's beneficial to diversify income streams, outgoing streams should be kept as simple as possible. Having multiple credit cards means keeping track of multiple due dates and, in many cases, multiple credits pull. These multiple outgoing streams, in addition to possible monthly or yearly fees, may even encourage you to spend more than you intended. It's important to make savings for the right reasons. As previously stated, in order to save for investments, you must ensure that you're saving in multiple departments with a specific goal in mind. While your savings and investment accounts are growing with the goal of becoming a millionaire by the age of 30, your daily savings should have a purpose. You may recall encountering a shoe sale on multiple occasions, and because it is 25% off last week's price, you believe you're making a good financial decision by purchasing the sale item. Not at all. Those shoes aren't necessary, and the X dollars you spend on them is still an outgoing expense that could be saved or put towards something else. While it's important to enjoy that 30% of your 50-20-30 budget, it's also important to bargain hunt with a purpose. Gain satisfaction from savings you make on bills, groceries, and other household necessities rather than from clothing or other expenses that wouldn't have been on your radar before the sale. Stop procrastinating because there is no magic. The youth's folly is to believe that there's always enough time to do everything. Young people frequently believe that retirement or wealth accumulation is something that happens later in life, and they're more preoccupied with immediate concerns. Unfortunately, this frequently results in a cycle of, "Oh, I should do that next month," month after month, until you're 10 years old and have missed out on a decade's worth of compounding interest. The first step is to stop procrastinating. Saving and investing can be intimidating, but the longer you wait, the fewer benefits you will receive. You may have come here hoping for a guaranteed, almost magical solution to make you wealthy, but no great reward has been achieved by taking a shortcut. There isn't a single one. The basic goals are straightforward: make money, then you spend and invest the difference wisely. It's up to you how you invest, but the obvious goal is to make investments that'll likely make you more money in the future. That is all there is to it. Making more money, spending less money, and investing wisely are all ways to achieve this. Be dedicated. Finally, you must be dedicated to this goal. It's a long-term goal that'll last long after you've made your first $1 million. It's critical to not live in the hope of dying with a net worth of $1 million, but rather to have a net worth of $10 million or even $15 million. Aiming high, such as $10 million, allows for even more exceptional goals of $1 million. Having someone you can vouch for, whether it's a family member or a friend who's doing well financially, can be a great way to ensure you're on the right track. Everything they say isn't meant to be taken literally, and everyone's financial situation is unique. Having them as a role model, however, will ensure that you're not alone in this. With that last piece of information, we've reached the end of today's video. We hope you liked our video. Please subscribe to our channel and remember to hit the like button, turn on the notification bell so that you'll be notified whenever we release a new video. And share the video as far as possible because the more you know, the more you grow. Goodbye.